Good day friends. In the area of personal financial planning, today I will be focusing on retirement planning. Some of the aspects of the retirement planning we discussed in our previous lectures on the retirement planning means in the lecture series on the retirement planning I discussed some of the aspects of the retirement planning, and in today's lecture I will be talking about some pension plans and the aspects which you should consider, which you should take into account while making your retirement planning. So means there are certain aspects, certain issues which we must plan so that we can have a post-retirement life coolly and we can pass on our property, pass on our estate with ease so that in future no issues arises. So to start with, I'll be talking few pension plans, and one of the very important and the popular pension plan is called employees pension scheme. Basically, the employees who are working in the government sector, they are getting pension either under the old scheme or under the new scheme, under national pension scheme, which I'll be talking in today's lecture. Especially people who are working in the organized sectors and the people who are working in the private sector, they want to make certain arrangements so that after their working age, once they get retired, they have some sum of money by which they can have their two-time meal or they can have their livelihood. So, Employees Pension Scheme, which is popularly known as EPS, EPS pension scheme was introduced by the government in 1995 and is also called as the Employees Pension Scheme 1995. Means the scheme itself is known as Employee Pension Scheme 1995. The EPS scheme was launched by the Employees Provident Fund Organization, is a very popular organization called EPFO, and its main aim is to provide social securities to the employees. Social security means that in case of any exigency, in case of anything happens, there should be some money that is being passed on either to the employee or to the legal heir of the deceased or the dependent persons. So the old pension scheme provides pension to the employees working in the organized sector after their retirement. There are different types of schemes which are there under the EPF or EPS schemes. One is widow pension, is also known as Vriddha pension. Under this Vriddha pension, a widow of the deceased member is eligible. That is, you contribute some sum of money, and once the person expires, once policy holders expires, right? Once the employee expires, then the money is being passed on to the deceased member of the widow of the or spouse of the deceased member. The other is called child pension. In case the EPF member is deceased, means after the death of that person, their surviving children become applicable to receive the monthly pension until the child turns 25 years old, as we presume that before the age of 25 a person is dependent. So if a person deceased and if a death takes place, in that case the dependent children are entitled for this pension. Orphan pension, like the child pension, there is another scheme called orphan pension. In case the EPF member dies and does not have a surviving widow, means if both the people die, husband and wife, the children of the member receives a pension under orphan EPF pension scheme, right? So means basic idea is to provide social security to the dependents so that if anything happens to an earning member of a family, some sum of money is being given to them so that their livelihood can be continued. Reduced pension, another scheme is called reduced pension. The member of the EPF pension scheme can withdraw an early pension if she has attained the age of 50 but are less than 58 years of old, only if they have made an active contribution for 10 years or more. What it means is reduced pension means after the age of 50, once you attain the age of 50, then between 50 and 58, if you want to withdraw some money, so that you want that for suppose at that age it is being presumed you need money for your children's, it may be higher education, it may be their marriages or something like that. So whatever the contribution that is being made by the employee and the employer, some part of it can be withdrawn, and the pension of the person pension of the person will get reduced to the extent amount withdrawn by the person. That's why its name is called reduced pension. What it means is that under the reduced pension scheme, some part of the money can be withdrawn between the age of 50 and 58, right? And then once the person get retired or after a particular age, then the pension starts. But this is possible, this is allowed when the employee has made active contribution, means monthly contribution or whatever the contribution interval is, right? The employee must have made contribution for 10 years or more. So who is eligible for this EPFO, right? Must be an EPFO member, must complete 10 years of active service with equal year of active contribution toward the scheme. What it means is that if an employee is is in active service for 10 years, but that employee has not contributed under the EPFO account for 10 years, so then the person will not be eligible under this scheme. So the person must contribute not only in the service but also contributed in the EPFO scheme, right? Employees Provident Fund Option Scheme. So there must be in 10 years service, means 10 years or more, it can be more, between 20 years, 25 years, but the contribution must be for a minimum period of 10 years and should be of 58 years or more, right? So this scheme, the pension will be allowed after 50 years or more age. So what are the benefits of this EPFO scheme? It provides social security, as I said earlier, to the employees, that the money is being given, is being passed on to the employee in a annuity form, in a monthly form, in a quarterly form, right? Pension is provided to the employees working in the organized sector during the retirement or after the age of 58 years, right? So means once the employee get retired, then or once the employee attains the age of 58 years, then this pension will start. This pension scheme allows certain arrangements for a member who wants to draw the pension funds early. Means under this scheme, there is also provision that if you want to withdraw your contribution earlier than which you have emphasized at the time of taking this pension scheme, that is also allowed with certain conditions. That is, early withdrawal is also allowed with certain conditions. EPFO account can be transferred to the widow or children of the member in case the member dies, right? Suppose if the person is in service for 20 years, 25 years and something happens to that person, then that EPFO account will be transferred to the widow of that person. So this is one of the scheme which is called EPFO, Employees Provident Fund Option Schemes. The other very important contribution which you can make, or other scheme which the Government of India has for the retired employees, is called Senior Citizen Savings Schemes. Friends, some 1 year or 2 years back, the rate of interest in India was quite low. So it was as low as 4%, 5%. For fixed deposits, it was 5%, 4%. And when a person retires, he has some sum of money, and there is no regular pension which the individual is entitled for. In that case, for his survival, for his meeting the day-to-day expenses or its monthly expenses or her monthly expenses, with the contribution which he has got at the time of retirement or after his working age, if the rate of interest in the country is very low, in that scenario, the monthly income or the yearly income or the inflow of income get reduced. So what the government has done is that you can deposit some money. Let me talk of this in detail. So Senior Citizen Savings Scheme is a government-backed saving instrument offered to individual aged above 60 years. Means it is available to only those individuals who are 60 years and above. The maturity period of Senior Citizen Savings Scheme is 5 years. That is, if you deposit the money in the age of 60, after 65, you can get your money back, right? However, the tenure can be extended by 3 more years after the maturity period of 5 years is over. Means once you get this opt for senior citizen savings scheme in the age of 60, and once the individual attains the age of 65, if the individual at that age or at that period of time, that time when he or she becomes 65, does not need money, then the scheme can be extended for another 3 years. Means it can be extended up to 68 years, right? So by 3 more years after the maturity period of 5 years is over. Means once 65 is being attained, then it can be extended for another 3 years, that is up to 68 years. So current interest rate, this is important, friend. Current interest rate from April 1 onwards is 7.4%, payable quarterly on first working day of April, July, October and January. As I was saying, friends, up till last year, at present the rate of interest in India is 6%, 7%, but up to, just 6 months before, the rate of interest was 5%, 4%, right? So at that period of time, the government of India had come out with a scheme in which if the senior citizens deposits the money under this scheme, it is allowed only for senior citizens, that is 60 years and above, right? In that case, the government of India will offer, or when I am saying government of India, it means the banks and the post offices in which you will opt under this scheme. You will offer, say, all nationalized banks, by and large all nationalized banks do this senior citizen saving scheme. So they will offer a special rate of interest, means for public it is 5%, but under this scheme the rate was 7%. At present it is 7.4%. So what are the benefits under this scheme? Tax benefits are provided, means you can contribute this money and the interest which you earn up to a particular limit, it is tax free, not the unlimited, up to a particular limit. Safe to invest in this scheme. It's very safe because it is a government of India backing. So scheme is very safe. You can deposit your money and you can assured be your interest in the principal amount. Premature withdrawal is allowed, right? If a person wants to withdraw the money earlier than envisaged, that is 5 years, so it is allowed, but certain conditions. The account can be transferred across the country. If today I am living in Chennai and tomorrow I shift my house from Chennai to Mumbai, right? So the account can be transferred, the same number will remain, and account can be transferred from Chennai to Mumbai. Means anywhere in any part of the country you can get this account transferred. High interest rate are offered. This is the most attractive feature of this scheme, that this scheme, especially for the senior citizens, this offers a higher rate of interest than the rate of interest prevailing in the market or that are being offered by the bank, right? Supposing a bank offers 6% rate of interest on a 5 years fixed deposit, but under this scheme they are offering 7.4%. Means that is simply saying that it is higher than the rate offered for other people. So under this scheme, the individuals who get this money under senior citizen savings scheme, who deposit their money under this scheme, they get higher rate of interest. So interest rate, it is just a table, it is being shown that what are the main feature of this scheme, senior citizen savings scheme. So interest rate is 7.4% per annum, investment amount, minimum amount is 1,000, and maximally, this is important, maximally 15 lakh is allowed under this scheme. Means if I want to deposit more than 15 lakh rupees, I am not entitled for it, right? Only up to 15 lakh rupees I can deposit. Premature withdrawal, yes, it is allowed. So who is eligible for senior citizen savings scheme? An individual who has attained the age of 60 years or above at the time of opening the account, right? So people below the age of 60 are not allowed. Individuals who have attained the age of 55 years old, but this is important, are below the age of 60 years old and have retired on superannuation are eligible to open this account, right? In the previous point I said people attain the age of 60 years and above are allowed. But now I am saying, supposing a person working in any of the sector, right, and that person is of 55 years plus, providedly that person is being superannuated, means get retirement or is being retired. In that case, even if the person is above 55 years of age and has retired, in that case the person can also open the account. The condition is 60 years, any individual can start 60 years plus. But for 55 years and plus, only those who get retired, who are superannuated. Thirdly, non-resident Indians are not eligible to open this account, right? So senior citizen scheme is not available for non-resident Indian. That is, put it the ways, only resident Indians are allowed to open the account under a senior citizen savings scheme. Hindu undivided family are not eligible to open this scheme, under this scheme, right? It means only an individual is allowed to open the account under senior citizen saving account. So what I am saying, open the account means you have to, under this scheme, you have to open the account either in the post office or with the bank, so that the bank or the post office will offer you this 7.4% rate of interest up to a maximum investment of 15 lakh rupees, investment or deposit. The other very important scheme of the Government of India to provide help to the senior citizens or employees is, or the individuals, not employees, I would say individuals, is called National Pension System, right? This is popularly known as NPS. This National Pension System is also a very important feature of for the retired employees, right? For the retired individuals. So National Pension System is a pension scheme sponsored by the government that started in 2004 for all government employees. Means when the scheme was started, this was started in 2004 for the government employees. But now the scheme was made open to all citizens in 2009. Means when the scheme was started, it was primarily means to cater the government employees. But from 2009, it has been open to all citizens of this country. So it is a voluntary and long-term retirement scheme. It is regulated by Pension Fund Regulatory and Development Authority and central government. Friends, there are various regulatory agencies, like for a stock market, for financial market, capital market, we say Securities and Exchange Board of India. For insurance, there is a Insurance Regulatory Development Authority. Similarly, there is a regulatory body in Government of India, in India, which is called Pension Fund Regulatory and Development Authority, popularly known as PFRDA, Pension Fund Regulatory Development Authority. This Pension Fund Regulatory Development Authority regulates the different type of pension schemes which are operational in the country. So this national pension system is also being regulated by the Pension Fund Regulatory Development Authority, which is a very highly creditable organization or regulatory body, right, which keeps a sharp eye on all the pension schemes, whether started by the different agencies which are permissible by the government or the various private agencies which starts various pension schemes. So who can join this national pension system? An employee from public, private, and even the unorganized sector can opt for this. A hawker, street hawker. If that hawker wants to open an NPS account, the person is eligible. What it means is, not only the people who are working in the organized sector means in the corporate world, in the private companies, the public limited companies, in the government sector, but all individuals, even who are working in the unorganized sectors, they are entitled to join national pension system. Personnel from armed forces are exempted, means this scheme is not for they are not covered under, they have a separate scheme. So this scheme is open to all across industries and location. Means person working in any industry, in area of life, right, they can be member of national pension system, the NPS, right. So must be a citizen of India, must be between the age of 60 and 65, right. So it goes from 60 to 65. Must be KYC compliant. Friends, KYC is very, very essential these days. What is KYC? Probably you must be knowing it. Know your customer. That is, whenever, even when you go for opening a bank account, what the bank will ask you? Bank will ask you your Aadhaar number. Bank will ask you your PAN number. If the PAN number, if you're a student and your PAN has not been allotted to you, then your account will be opened with the identity card issued by the school, right? Means your address proof. So whenever any type of account is being opened where some financial transactions takes place, there are certain formalities which are to be undertaken, and each institution wants to know its customers, right? So which is popularly known as KYC, know your customer, right? So under the know your customer, normally the practice is you must have an Aadhaar card, you must have a PAN number, right? Which your residential proof must be identified, because through Aadhaar, through PAN number, your address and the age and will be identified. So whenever the account is being opened, there must be KYC will be done, or we say KYC compliant. And these days, once you comply the KYC, for any other transaction, any other financial transaction, the new KYC is not required. Once the KYC is compliant for any purpose, for opening the bank account, if I have done my KYC, then for national pension scheme, I will not have to make my KYC again. It will automatically be taken. But I must be KYC compliant. Must not have a pre-existing NPS account. That is, you can't have two NPS account. National Pension System, you have only one account. Means I'll be telling you an account number is being issued when you open the account. So what are the benefits of National Pension System? National Pension System, or National Pension Scheme, popularly known as, is transparent and cost-effective system wherein the pension contribution are invested in the pension fund schemes, and the employees will be able to know the value of the investment on day-to-day basis. Friends, there are certain agencies like, for example, UTI and various others, which have been authorized by the Government of India to have national NPS accounts. It is simple. So all the subscriber has to do is to open an account with her or his nodal office, means, and get a permanent retirement account number, which is known as PRAN. Once you open an account with the National Pension System, you will allotted a number, and that will go on throughout your life, right? Till the time you keep this money in the National Pension System, right? So a PRAN, which is known as Permanent Retirement Account Number, will be issued. Then your identity will be through PRAN only, through your PRAN number. It is portable. Portable means wherever you go, each employee is identified by a unique number and has a separate PRAN which is portable. Portable means if I go from other part of the country, from Delhi to say Kolkata, so I'll just get my account transferred anywhere from any part of the world. I can see that what my transactions are, and it is always transferable. So will remain same even if an employee get transferred to an other office. Suppose in private company, individual working in a one company get transferred to other company, right? So the same account will be transferred to the other company. It is regulated, right? So National Pension Scheme is regulated by the Pension Fund Regulatory Development Authority with transparent investment norms and regular monitoring and performance review of fund managers by the NPS Trust. There is a trust called National Pension System Trust. This money which the employees and the employer contribute, it is regulated by the Pension Regulatory Development Authority, and it is being managed by National Pension Trust. So under this, there are two types of account, which is known as Tier 1 account and Tier 2 account. Tier 1 account, it is non-withdrawable account meant for saving for retirement. Tier 1 function as a pension account, and withdrawals from it are subject to specific restrictions. Means you can't withdraw at any point of time. You can withdraw, but there are certain restrictions in it. So an individual can open this account with a minimum deposit of rupees 500. I mean, there is no maximum limit. You can deposit more also, but for minimum deposit is 500. And there is another account called Tier 2 account. This is simply a voluntary saving facility. The subscriber is free to withdraw savings from the account whenever subscriber wishes. No tax benefit is available in the Tier 2 account. But only thing is, it provides liquidity of funds, investment for investment purpose and withdrawal purpose. So the minimum deposit needs to make in the Tier 2 account is 250. In Tier 1 minimum is 500. Here even a person can deposit 250, rupees 250. However, investment in tier 2 account are allowed only when active tier 1 account in the subscriber's name exists. Means you can have tier 1 account, then only you will have tier 2 account. Means you can open tier 2 once you have a tier 1 account. So friends, this was about National Pension Scheme, Senior Citizen Saving Schemes and Employees Provident EPFO. Right? So I'll be continuing this national pension, remaining part of the national pension scheme in my next lecture, and other areas which you must cater, which you must take into account, which you must plan for your retirement. Thank you very much.